Chairman Powell of the Fed raising rates.
Just another round of rate raising. What is this, the 10th one in the last year?
I think it's the 10th. Yeah. So rates, you can see they came down, obviously, in 2008 from around 5%, came all the way down to close to zero, basically zero. And then 2016, when Trump became president, they started raising them pretty quickly, actually, looking sort of like once a month, once every 2 months. And then obviously when COVID hit, they'd already started lowering rates a little bit, but then when COVID hit, it's like boom. But now we've got one of the steepest rate raise, certainly for the last 20 years.
In history, we started 2022 at 0.08% on the fund market, right?
Wow.
And now we're at what? 5.25%. Yeah.
Yeah, 5.25.
Literally in the course of 14, 15 months, 6,000% it's gone up. That's the most that we've ever seen. The next closest one is from the 1970s when we were going up, or 2016 when Trump came in, went up 200%. Prior to that, in the 70s and 80s, we were at 70, 80% increase. And that's when we were fighting inflation that was at, 14%, 17% numbers in the
we probably are fighting inflation that's at 14% if you go by the way they worked it out in the 80s. So it basically is the same, isn't it?
Yeah, no, that's the whole thing, is the whole inflation regulatory. How do we gauge what the baskets of goods are? If we were to put all eggs in there 6-7 months ago, we would have had inflation at 80%. So it's just whatever they want to put in the basket to make it not seem as painful is what they're doing.
Yeah.
But fundamentally, I think he's going to have to keep raising rates. There's no question about it. I mean, the jobs report came out today, and what did we add?
200, good, wasn't it?
Yeah, 260,000 jobs. No one expected that. That's crazy.
It's such a weird economy we're in right now. It's sort of like we've got a recession going on and a boom with the stock market at all-time highs, and jobs increasing at record levels.
And then the thing, gold just hit is like $50 away from being our highest peak. It was at $20.50 yesterday. It dropped $30 an ounce. But it is the weirdest economic macro micro that I think we've ever going to see.
Well, yeah, I think it's because of just all the money. I mean, they pumped like $9 trillion or something into the economy because of COVID. So still some of that money is having an effect even now, coming out of a recession, weren't we? We came out of a sort of flash recession. So we were both recovering and going into a recession at the same time. So those two things have sort of equalized and given us the economy we have now.
Yeah, we're in the middle of tumultuous problems with the regional banking issues, with inflated numbers. I mean, I feel like there's a tendency here to manipulate the market, manipulate the actual speech and how we present things to people so that it actually shows a benefit. And the truth is that there is no way to put it except that this isn't normal. What's happening right now is it's not the way it's supposed to be.
The Fed raising rates definitely has taken out a load of the regional banks. I mean, that is the reason why these banks have failed, because the bonds they held were yielding too low an amount, and they ended up having to sell them at a loss in order to satisfy people taking money out of the bank. So far, 4 banks down, or is it 3? I think it's 3 due to this reason.
Yeah.
So far this year.
There's a couple more on deck right now. I mean, PNC. PacWest got hammered this last week, but PNC, regional bank, really big regional bank, put $15 billion of commercial real estate paper on the market at the beginning of the week. You saw their stock dip. They're still holding that over $100 a share, but all these regional banks are just getting attacked. But the interesting thing about the mortgage and the federal rate is, like, how does it affect everybody else? When you think of the reserve rate, you think of the mortgage rate increasing. So if they increase the rate from the Fed, then your mortgage increase. Well, in May and March and in April, they did increase, but the mortgages decreased. So it's not the mortgage rate decreased. It's not necessarily goes along with that trend. Yeah. So here you can see what the mortgage rates are over the last 30 years. You can see that super peak right there. You had mortgage rates at, what is that, 17%, 20%? That's in the early 80s when they were trying to fight inflation. And then you see down towards our end where recent times where the mortgage rates kind of shot up to were the the mid 2000s, early 2000s. So it's interesting to look at it because how does it reflect to like an everyday person? 99% of the population doesn't deal with the Fed fund rate between banking loans from one another. But what affects everyday people is a mortgage rate, right? People buy homes every single day. People want to buy a home. That's kind of like the American dream. And right now you see the mortgage rates going up and down. We're at, 6%, but we were at all-time lows 2 years ago. So it's interesting to really think about how does the Fed rate really affect the everyday person? And it affects it by knowing that it is reflective of what's available to give out and how much money we can lend.
Yeah. And the housing market is pretty slow right now because of the Fed's whole raising rates, isn't it?
Yeah, it's calmed down. I mean, in 21, it was the housing boom. Into 22, you saw everything go crazy. People are paying, sometimes $50,000 over asking price almost across the country on different houses. And for the last 3 months, we're starting to really stabilize, and there's a little bit of an uptick in the cost of homes. A lot of that has to do with, there being such a tremendous bubble after COVID of people wanting to move, get out of wherever they were at. You spend a year in a house, you're like, all right, I'm done with this house. The mortgage rates averaging right now at 6.5% to 7.4, depending on what your lender's doing and what your credit score is. But that's how it affects. And it's interesting. You look at the previous Fed chairs that dealt with crazy inflation, Paul Volcker and Arthur Burns. Right, Volcker pretty much controlled the 80s. Burns pretty much controlled the 70s when it comes to the Fed chair position. And they both were fighting inflation by raising federal rates. And it's, I think Volcker probably had the biggest challenge because Burns raised it up until 74 and then he lowered it. He thought he was doing something well. And then he had to raise it again because inflation was coming around the corner in 78. And so now, there's Paul. Yeah. Fresh out of 1971. He had to definitely backtrack, and Arthur Burns had to backtrack too. And I think Jerome Powell doesn't want to do that. He doesn't want to backtrack and say,
they're already talking about that though. I mean,
right.
on analysts on the news and stuff, they're already saying, hey, maybe come July, they're going to actually start lowering a little bit.
I don't think he's going to lower the rates until he absolutely has to. How I would view it is there's a recession that's going to have to kick in before he starts to lower rates again. I think we'll see a raise in June, and probably another one. We might go stale in June where nothing, no change, but in July we're going to see one. We'll see it until October when we start to see the economy switch a little bit, and I think take a little bit of a dive. But ultimately, it's a really weird environment right now with everybody. Is how much is going on. Like the jobs don't make sense, but when you look at it, really, baby boomers quit working after COVID. Anybody that was close to the age of 62 just said, you know what? No, I'm just going to retire early. I'm going to call it a day. 59 and a half, you can start getting your Social Security, if you paid into that and you've done it. So people were just kind of calling it a day after COVID. And now our employing market is drying up. So we need people to go to work. Still, you see everywhere you go, now hiring. And it's interesting.